Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 20th of February, 2020. And tonight's video talks about the warning shot that the market just fired at all traders. We'll talk about what that means and just get a kind of a permanent reminder that volatility lurks around every corner, even if it sure feels like every day is up, 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 up. That is not the way the markets work. So we'll talk about the warning sign fired across the bow of the trading desk of all of us here in TheoTrade and beyond. First, let's talk about this. Earlier in our trading session, we were talking about trades off the 9,700 level in the Nasdaq futures. And blink your eyes, go get a cup of coffee, and next thing you know, the Nasdaq was down 200 points within 20 to 15 or 30 minutes or so. So these things happen. Markets have volatility. So this is a warning sign that markets don't go straight up. The comparison point for the S&P fell just shy of the 3,400 level all the way down to 3,340. So that was roughly a 50 to 60 point move in the S&P futures. And the Dow, that was a, of course, larger point move, roughly 400 or 300 and change. The main picture here is from the volume profile type of charting. We had the upper value area extreme all into this 3,390 level. And the game plan, short term at least, was to play away from all these highs or these upper pivots down toward the lower point of control, which is the red line, all the way to the lower, that's the yellow, value area extreme. So we got that move within one session. And that one move, really the few hours of this chart progressing, took out the trading activity of the last week or so. So again, markets can move. They don't go straight up, even though they sure feel like they do. On the bigger picture, here's where we are. So in the S&P futures, we have this 3,400, which is a round number pivot, and we have the 20-day exponential. It's the VA extreme, but it's also the weekly expected move, which hit that, as Don reminded us, to the penny in the S&P, and that was roughly 3,340, 3,339, and we had that pivot reversal up away from it. So that's the key level that we're watching. If I'm kind of drawing a parallel really to earlier in January, where the market fell with an overextended rally, similar type of structure, similar type of play really, extended up. This thing will never go down, and in one session took it away from the new highs back to the 20 exponential. You did have a little bit of a push up, so that is what we're seeing in today's session. But the next session was a down, and of course the market went all the way to the 50, which was, at that point, roughly 100 S&P points lower. So we are setting a parallel, possibly, maybe, potentially. Either way, it's a warning sign that, hey, I'm the market and I can fall. Even though you don't think I can actually fall pretty hard, pretty quickly. So that's where we are in the structure. Now, I know if you've been with us since October forward, you might think the market goes straight up. But in 2019, there were periods similar that led not just to the 20 exponential, but the 50, and then all the way to the 200, which sort of serves as an adaptive magnet or target. So these sell swings look like a big event then, and it really hasn't happened since later in the 2019 year. So that's what we're on guard for. That's what the market, I think, is sending to us right now, with the most recent pullback being a steep one. And the market just saying, don't think that I go up forever. Another way to look at that is the infamous or famous 2017 into early 18 period, where it sure did seem like this market was never going to go down, and all of this price action was wiped away, destroyed, gone within 2 weeks. Not predicting this, but just saying that there are warning signs on the horizon. Same is true for other markets, including the Nasdaq, and that was even worse of a pullback into 2019. Beyond the S&P, let's take a look at some interesting developments that we've been discussing and trading and doing some vertical spreads. For gold, I think this is that canary in the coal mine type of thing. If you look at this from a broad perspective, gold is up above 1,600 per ounce. And that's bullish. It's bullish for the broader market, at least broader gold. And that is paralleled or followed right alongside with Treasuries that are also making a similar pattern. So we remain and renew our calls for bullish type of trades, vertical spreads, in-out spreads, call spreads, or just intraday tactics for bonds to keep going up to make, ultimately, new price highs. So these daily charts are interesting, that bonds, bond prices at least, are up into their 2019 highs, with the equity market at its own series of price highs. Keep this date in mind, August, September of 2019. Keep that in mind for a moment as we take a look at the S&P. So this August period here was before the stock market fell. So higher bond prices, it's kind of off the rails at the point now, but higher bond prices tend to be bearish, or at least competing money flow for equity prices. And the same again is true for gold and bonds. You can look at TLT as well. So those are where the markets are at. So even though we have a bullish type of trade, we have a successful outcome for those trading short-term in-out spreads up away from the 51 price level, went a little bit beneath it to 50, and the first target was roughly 54.50 or 55, loosely defined, as a target. So for crude, that target is achieved. Here's the interesting part. We are at this point now. Crude has, I think, better odds of pushing up to this 58 marker. But if that starts to fall and stocks take a tumble down, crude probably goes with it. And there really isn't a bottom underneath this 50 print or pivot or price. Now, before we conclude the video, let me take your perspective up into weekly charting. I think that's where the market warning signs are. So if crude starts to fall, keep in mind crude oil and the equity market tend to go together. They're positively correlated. Even though the equity market is up here, crude is not. So that is a separation of their relationship. It's something that's interesting to note. If stocks take a tumble, and you're going to see crude tumble probably with it back to 42, 45, or prior lows. So that is your drop zone for the crude oil market in the extent, or in the event, I should say, that stocks actually do fall, or I should say when they fall, because I don't think they're going up forever, but they sure feel like that at the moment. Again, that's crude. Gold remains in an uptrend, and we could even pull that perspective back further to see the monthly chart. And that just takes us back, let's go back 10 years, and monthly for gold. From that perspective, you can see that there is additional upside activity up toward 1,800 per ounce in gold. That is a possibility. And if this market keeps getting bullish type of money flow, you'll again probably see equity prices fall to the downside, or at least put pressure on the equity market. The same can be true with TLT, which is up there at the highs. And of course, it's a little different, but the bond market. So these things are warning signs. And today gave a little bit of a caution. Doesn't mean run out and sell everything. No, those in-out spreads or bear type of verticals or any type of defensive hedges, those should already be on. We've had plenty of time. We all have had plenty of time, and all the traders in the world can see the market is overbought, overextended, but we just can't get that money going or working for us with any type of short trades. That won't be the case forever. So patience is key, protection is key, and if you haven't already, now is the time to start thinking hedging, or it's past time, but there's no time like the present for those type of strategies. As always, be careful and safe. This is Corey Rosenblum with your Theo Nightly Video for February 20th, 2020.